All right, guys, folks, I'm going to start. Today, we're going to talk about the big, beautiful bill for businesses. I believe next week is the one on the individuals. It's chock full of information. I'm going to try to make it as fun as possible and innovative as possible. I'll look for you guys to help as well as we're going through. Um, as we start, I'd like to just go to the next slide, which is a poll question. If you can just share this in your chat, what is your go-to coffee, tea order typically for the morning? I think this just kind of makes things light and for all of us. Obviously, this is a dry topic, but it's important that we just start out our morning, and then one of my associates will just provide that for me. So it just helps us make sure everybody's engaged. Number two, it also just gives us the ability to make sure you can hear us clearly, and then thirdly, as I said, it just provides some levity to the situation. You can go right to your chat area. Well, guys, thank you very much for those that put in there. This is helpful just to kind of get going. So, right.
What do you get?
So typically for me, I'm not a coffee drinker. I drink orange juice or water. I gave up coffee probably about 2 years ago. And it helps certainly get me through the day. And my wife says I'm not as cranky as I normally am without the coffee. So to just get through that. So I wanted to kind of do some general housekeeping pieces. Everybody's going to be on mute. We were cameras are turned off. It just helps us keep the minimum, noise to a minimum, ensures privacy of the meeting. It is being recorded, so we certainly can provide you that tape as well. I think that everybody is anonymous, so everybody doesn't know who's on and who's not. We have about 20 plus participants today. So people will be coming in and out. Please let us know in chat if you're experiencing any technical difficulties or if there's something that's not working for you. You can re-enter and drop off at any point. We have no problem with that. As soon as the recording is available, we will share it with you. And you can share it with any other interested clients that you may know. This is an interactive session, so please ask questions. Put them in the chat as we go. We'll address them at the end of the session as best we can. I think one of the things that we need to realize is this legislation is evolving. And just to throw that out there, not sure if everybody's aware, but the IRS is actually shut down as of Tuesday night. With the government shutdown, they said that they were going to extend, but they are currently now shut down. So this legislation is being written. It was passed on July the 4th, but the actual details of it are still emerging. And so it's hard for us as professionals to really understand what the impact is. Every day I get a little clip. I try to piece it together, but it's evolving. I will share this with you. It's most likely that the tax season will be extended for 2025. Right now, due to the fact that the government is such a small reduction in force, that they're saying that it will not be able to probably be able to start filing tax returns until the middle to end of February, which would extend the tax season past April 15th, most likely to June 15th. That is not concrete, but that's what we're hearing from sources within the Internal Revenue Services and some of our professional organizations. So from a planning and a strategic perspective, these are things that you certainly consider helpful. This would delay processing of payroll returns, W-2s, 1099s, and obviously any partnership and corporation, those returns would be extended as well. All right, so today's objectives, obviously to provide any knowledge and personal professional growth for everybody here. So it's really for education to make sure that you're aware of what's going on, what the impact is going to be. We will look at this as productive so you can collaborate, and this would be a great opportunity to just get a blank sheet of paper or a notebook and take some notes down, because as we start getting ready for tax planning season, which starts after next Wednesday, which is our deadline, which is October 15th, even though the government shut down, all the final individual returns are due on October the 15th. So as soon as that takes place, we get into tax planning session. So use this as an opportunity to jot some notes down, think about some planning. These are certainly things that we can, discuss. Obviously, we talked about audience engagement. We're encouraging you for active participation by typing in questions, as you did with the polls, etc. Make some goals. Think about what changes you can make, what changes you want to discuss with us, what we can do to help move forward. I think this is a great opportunity for us to share and educate. I think I pointed out earlier, we are going to have a series of these. I think the next one will be next week, which is on the individual. Again, it's an hour long. It's chock full of information. This bill was 1,000 pages, but there's a lot of detail in it. It's probably the largest legislation change in over 50 years. So certainly something to consider and to think through. We have another one, which is gearing up for tax season. Um, Another one for small businesses, what not to do and what to do to make sure you're successful. Our core competency as a firm is really any size organization between zero and $5 to $10 million. I think that's where our core is. So I think that we try to pull this together more for that space rather than some of the larger corporations. We talk a little bit about our firm and what our main objective is today, and I'm sure you can see this from our marketing collaterals coming out to visit clients. We are moving from a tax preparation firm to an accounting advisory and consulting firm. We want to continue to be that strategic thinker for you. We want to be proactive. We want to be thoughtful. We want to make sure that we are ahead of the game, and we're just not here and you see us at tax time. Hopefully, we're meeting those objectives, and if we're not, please feel free to reach out. I mean, that's what these sessions are for, is to really push us through and to make sure that we are strategically aligned with your business. We understand it. And we're going to try to get closer and closer every year. And the investments that we're making as a firm, I believe will start showing in the next year or so. So the agenda today, we're going to review the bill, right? This 1,000-page act, we're going to talk about it. We're going to talk about the impact of the bill on the economy, what it's doing and what it's not. There's various changes of the bill, from those laws that we're going to be sunsetting to those that were amended, some new legislation. It's also going to provide you some compliance factors. And then there's some outlandish changes which are creating some significant business opportunities and investment opportunities. And we're going to talk through that a little bit. And the last thing we'll finalize with is just tax planning tips, right? With all this legislation, what things should we consider and what should you consider as we start the end of this year and next year? Because some of this legislation will be effective as of January 1st, 2025, and some of it will go into 2026 and 2027 when it's active. I will talk a little bit about the individual, only to the fact that there's certain impacts for pass-through entities. And from an entity structure perspective, I wanted to lay that out, kind of just talking about that. So a regular or pass-through entity or an individual company would be a Schedule C or a 1099 or a gig worker, to a partnership, to an S corporation. Those that are other entities would be considered as a C corporation. So, some of these, when I talk about pass-through entities, we'll talk through, and those are specifically, again, Schedule C, gig workers, 1099, partnerships, and S corporations, and the other one, which would be C corporations. So the beautiful bill, right? It passed over the summer. The benefits have barely yet to be seen, but they will be starting to be seen shortly. Many small businesses stand to gain significantly from this tax law deduction into next year. Some key ones as high as 100%. The favorable tax measures are not entirely new. We're going to talk about that. Some of them are just the fact that they were going to expire, and now that they're able to be used moving forward, in regards to that the legislation was pushed forward. But there's no such positive, in regards to the changes that are going to take place. This is sweeping changes in the tax code. We have not seen this in over 30 or 40 years. As I said, if you looked at the bill, the piece on the business represents about 40%, and 60% is more on the individual side. This is specifically for small and medium businesses, the discussion today. So we're going to focus specifically on this. But overall, it's going to be a boon for small businesses. Whether it's, if you look here at the pictures on the bottom, whether it's a bakery, to those that are in construction, to a barber shop or a salon, or even to a pottery gallery. Everybody's got a benefit, right? And the question is what is that benefit and how can you take advantage of it? Looking at the why was the one big bill, beautiful bill designed? Specifically, it was to stimulate investment. Trump looked at this and he wanted to label it um, as big of a marquee as possible. He wants everything big and glorious. So what he did was is he packaged all this legislation and put it in this 1,000 page document. And so it's got a big marquee. It looks great. Everybody's talking about it. It's in the press, but it's really here to stimulate investments. And what I mean by investments is that he wants small and medium businesses to stimulate the economy by making purchases, by hiring workers. So those are one, and that's why we're seeing, some of the benefits that are going to be coming out of here. The people, our small businesses will see more cash in their pockets, but there's going to be some pros and cons, which we'll talk about later. Number two is it's created innovation and it's in domestic production. He wants to make sure, or the government wants to make sure that we keep the economy here locally and not necessarily internationally. And you can see that from the tariffs. There is some thoughts that this is reducing employers' burdens. There is some, but there's not. We'll get through it. So I think that from an employer burdens perspective, there's some changes, and we're going to get into that, or specifically in regards to compliance, to the fact that there's going to be additional compliance or different things that you're going to need to do now as an employer. And specifically, it could be managing tax on tips, or managing what the tips are, to managing overtime, um, to some benefits somewhere else. So we'll kind of go through there. There's some strategic tax savings for certain organizations, and what I meant by pass-through entities would be partnerships and S corporations. The tax savings there we'll get through in a sec. Manufacturers, those that are in the manufacturing space, there's some significant benefits that are coming out of here. And then for startups, small, medium businesses that are just starting up, there's some tax incentives there as well. So if you can, another poll question just to keep you guys engaged. Since the Big Beautiful Bill Act was passed in July, has your business experienced any positive or negative consequences since? So you can share that in the chat. That would be helpful. So folks, in regards to the, we're getting some feedback here. Some folks have seen no impact, and some are saying that they're now having the impact of paying for overtime, and for tips. So those are some things that we'll certainly think through. The benefits of this are not going to happen until tax time. You're not going to really experience those. So let's talk about the pros and the cons of the benefit of the bill. So again, we talked about the pros being increased investment and growth. We're starting to see that with when we talk to some of our bankers, the facts that many more folks are investing in the economy. They're looking at, they're very pro, and there's significant growth. We're also seeing significant cash flow because of the fact that our workers are now seeing the advantages of not having to pay taxes on overtime and also not having to pay taxes on tips. There's a competitive environment that exists, and there's some assists that have passed through entities. We talked a little bit about the help for startups. Sorry. The cons are, and I'm sure we can all see this and appreciate this. I don't know if anybody's gone to the grocery store, but the inflation for purchasing um, goods and services has increased significantly. Um, and secondly is the interest rates. We have not seen any significant interest rate drops for either acquiring equipment, acquiring vehicles, um, or even home mortgages. So the cons there are continues to be a negative. The cost of capital, which is really what does it take for me to run my business and to borrow money? That increased cost is certainly there and it continues to rise. We will see, as much as they said that the burden was going to be lifted off of this new bill, we're going to see some complexity and some client compliance cost in order to make this happen. And we're going to get into that as we get into the meat of the bill. The changes to the energy sectors, we have many clients, specifically in the commercial space, that we're putting on solar or doing other energy improvements. That specifically will end. So as of January the 1st or December 31st, any energy sector incentives are no longer. That's certainly something to think from an investment perspective, and also certainly something to think through as we start looking at, from an investment perspective, if you're looking at making financial investments, are they the right investments, especially since the energy sector is going to start losing those incentives. There's new foreign entity rules. So if you have a foreign or international firm, or you're a partnership, or you have a foreign partner, the government's added more complexity to that. And then there's significant elimination of other benefits. And those are more on the individual perspective, whether it be Medicaid, SNAP funding, all of those has been eliminated. And the other con of the bill is there's significant push for immigration laws. So essentially, a lot of people believe that the one big beautiful bill was here to pay for the work that needed to be done for taking care of the issues in regards to immigration. What's included in this legislation? We're going to talk about the renewed, or the bills that we're going to sunset, to some amended changes, to actually some new legislation, and then some compliance factors. And then there's the last piece here, which I have is outlandish. And what I mean by renewed is which programs we're going to be sunsetting and what the advantages were, though, that are going to now be taking advantage of the fact that they are now renewed. So looking at the sunsetting pieces of it, one being the Tax Cut Jobs Act, tax rates. We'll talk about that. We'll also talk about the tax rates. The amended changes, what laws have changed and how have they changed and what the impact is. And then the new legislation we talked about. The dollar signs that I have really show the impact. So if you looked at the bottom in the bottom boxes, the $3 signs say, hey, this is extremely lucrative, this piece of it. So if I looked at this, it's really the two bookends, one on the far left, which is the renewed, and the last is the outlandish. The renewed is immediate. The outlandish is really when you see it and you can kind of get a glimpse of this, the man in a spacesuit, it will really long-term strategically help benefit the organization, or financially for you individually. But it's something we certainly need to talk through. The renewed is immediate, and we'll get through that in just a sec. We'll start there. The renewal of legislation ending on 12/31/2026. This was the Tax Cut and Jobs Act when Trump first came into play. So essentially what he did was, or government did was, is they extended the tax rates. And if we didn't have those tax rates individually and at a corporate level, we were looking at an average of a $6,000 or $7,000 additional tax bill. So this renewed vision, or this extension, or of the sunsetting laws, certainly has an impact on each of us individually as well as our business. The second is in regards to something called the QBI exclusion. We'll get into that in a sec. And the third is permanent 100% bonus depreciation. So the corporate rates were reduced from 35% to 21%, and those would be for C corporations. That was the first thing that was extended. Secondly, the individual rates remain. So these are things that the Tax Cuts Jobs Act, these tax rates have been extended. They were supposed to come back, and they were also supposed to look at adding back the alternative minimum tax. So from a sunsetting perspective, we've now extended those. As we talk about QBI, qualified business income deduction, this is for any pass-through entity. It was supposed to expire on 1/1/2026. This has moved forward now for the next 3 years. Or actually, I'm sorry, this is permanent. And what this does is if you have a pass-through entity and your profit is $100,000, this allows you to take a 20% deduction off of your taxes. So what is the impact of that? On $100,000, your tax rate's 20%. It will be a $4,000 savings. Again, what a pass-through entity would be a partnership, a individual gig worker, or an S corporation. It would not be a C corporation. So this QBI deduction is extremely beneficial, and it's also improved what the percentages would be and when they would phase in and out. The phase out for single filers is $197,000 to $247,300. Married filing jointly is $394,601 to almost $500,000. One of the things that we need to consider here is that there's certain industries where this becomes a challenge, and those industries would be accounting, legal, medical, consulting, etc. The phase outs are a little bit higher, I'm sorry, a little bit lower. So that's certainly something that we need to consider. So if you're an attorney, if you're an accountant, if you're a medical professional, consultant, these pieces don't give you the flexibility as maybe some of the other folks. But this is a significant benefit. Just looking at that on $200,000, if you looked at it and said 20%, that's 40 grand, and the tax rate, let's say, is 24%, you're looking at $8,000 or $9,000 savings. It's a huge benefit. It was made permanent. It makes us look from a planning perspective. It allows us to really focus and say, hey, this isn't really going anywhere. And obviously, with tax law, it doesn't mean that it's never going to go away. Permanent means it's permanent right now until the next legislation comes in. I guess the phase of is we don't foresee a sunsetting until there's a change in who the presidential candidates are. So some questions to consider, and you can certainly put these in here or put them on a sheet of papers. Should you consider an entity change? Right? Some of the factors that you should consider is what is my current entity structure? Number two is, do you have any net operating losses that you need to harvest? Number three is, have I already spoken to the team to discuss strategically, is this the right direction? Those factors that you also need to consider are what's your income level? What is the industry that you're in? What is the financial economic benefit? Now, from a partnership perspective, this doesn't factor in real estate. It's only for business. It's got to be operating income. We also need to consider here looking at what your salaries are versus what your distributions are if you're an S corporation or a partnership. Really looking at what the guaranteed payments are, because that will certainly have an impact on what that QBI exclusion would be. Is it reasonable? Is it realistic? Those are the things that we really need to factor. So just some questions to consider. As I said, put a sheet of paper or a pad as we're talking through this. It's nice to write that stuff down and just talk through it. I just wanted to take a quick survey, if you don't mind putting it in the chat. But if you can just note if this is helpful, is the level appropriate? Is this what you were expecting? Because obviously I can pivot and make some adjustments as we're going. Thank you. All right, so I know that from a timing perspective, we're at 9:30, so I'm going to be kind of going a little bit more quickly through the slides to allow for questions. Bonus depreciation. Bonus depreciation really is looking at what's available in regards to if you purchase a vehicle. So the bonus depreciation, again, was supposed to sunset and it's now extended through. This allows you 100% bonus of writing off a vehicle, whether it's a truck, an excavator. We have some folks that are in the trucking industry that are on the call. We have some folks that are in construction that talk about excavators or payloaders, etc. This schedule now gives us the ability to write off 100% bonus depreciation up to $2 to $3 million of assets before it was supposed to be shrunk to about $500,000. So this is again extended. It's worked out really, really good. This would certainly help as well. Again, permanent 100 bonus depreciation for many business assets acquired after January 19th, full deduction of this depreciation over multiple years. Accelerates the deduction, improves cash flow, and also increases the return on investment. So let's talk about those are the, I guess looking at the three pieces. One was the reduction of the extension of the tax rates. Number two is the QBI exclusion for partnerships and S corporations and gig workers. And the third one was in regards to the bonus depreciation. Quickly on the amendments. Section 179 exclusion expanded. Business interest deduction, small business stock gain exclusion, 1% deduction on charitable donations, Clean Energy Act credits, R&D expenses. Those folks that are in the construction industry, a percentage completion. We'll talk through that in a sec. And then the commercial energy cars. And lastly, was the manufacturing investment credit. So the law prior to the bill passage for the Section 179 was up to $1 million reduced by the amount which the cost of the property exceeded 2.5. It's now been increased so you can expense up to $4 million. So some folks that are making some significant capital and expenditures, this is probably the time. This applies for any property after December 31st, 2024. This also, from a planning perspective, you probably, if you have real estate, this will help you as well from a Section 179. It may want you to do some cost segregation analysis. And that's certainly something we can talk through as well. Because you have this ability to write off some large capital improvements. Section 179 means is you take the asset depreciation over 1 year rather than taking it over a 3 to 5 year period. So certainly something to think through. Number two is the business interest deduction and capitalization. So folks, what happened is if you had a significant amount of loans that were out, you weren't able to take those deductions on the interest. This now allows you to consider depreciation, amortization, and depletion as part of your calculation. This didn't take place prior to, and certainly expands the definition of, helps those folks. We have a few folks that have used car lots, floor planning financing for those vehicles, for trailers and campers and even cars. This certainly helps with that, and that's certainly something we can talk through. Small business stock. There's an exclusion. This exclusion has been increased. It allows those companies, and this is really for somebody that's founding a company, and this is really something strategic. It allows you, if you have started up a small business and the way that it's structured in their stock, it allows you to exclude portion of the capital gain that's available once you sell the asset or the business. So this is really a strategic play for anybody that's starting up a small business, and this is really just for small business stock. Number four is the floor on corporate charitable deductions. Prior to this, you weren't able to take a deduction on any of your donation. They've now given us a corporate floor that allows you, the corporations, S corporations, partnerships, to take a deduction for donations, and it's increased that floor. So this is certainly something from a planning perspective that if you are going to make donations, this was effect as of 1/1/2025. Energy efficient credits. This eliminated the deduction for new energy efficient commercial buildings. We talked a little bit about this. So effective June 30th, 2026, this goes through. So from a planning perspective, we have many clients that are trying to rush to push those investments in before the deadline. Deduction for research and development expenditures. they've made this much more expansive, and they've given us the ability to go back 3 to 4 years and look at research and development costs to take those over a 1 year period rather than taking them over multiple year periods. And when we talk about research and development, it could be something from setting up a new software program to looking at expanding your market and doing the research and development and not taking that expenditure in over multiple years and pushing it to 1 year. It also allows you to look at folks that are going into new markets and coming up with a new product. So this research and development is really a significant benefit for those folks in that space. Percentage completion, we have some folks that are again in the construction piece. So they've changed the rules in regards to the accounting of percentage completion for construction projects. So essentially, you were able to recognize the revenue on a certain level. It had to be done over a certain period. They've now shortened that period. So as you're thinking about strategically what that means for you and your business, you can look at expanding those out for new construction projects. Those folks would be ones that would have multiple projects going. And I guess the question would be, what's the accounting of that? How would it be done? And what's the advantageous? So essentially, it allows you to expand that out to give you more flexibility for recognizing revenue in a little bit more fluid way for your benefit. The commercial clean vehicle credits, we have a lot of clients that went off and they've gone out and gotten some clean vehicles, whether they're electric SUVs, whether they're electric vans. Those credits are now effectively, again, no longer as of January the 1st, 2026. Advanced manufacturing investment credits. We have 2 or 3 folks here that are in the manufacturing space. That credit is now increased from 25 to 35%. So if you're making investments into production lines, buying new machinery, equipment, you now can take that credit from 25 to 35%. And so in some instances, it's about $5,000 to $8,000. So it's certainly something to think through. The new law changes, right? So we're really going to talk at this at a high level, and we could certainly talk through what the impact is as well. First one's going to be no tax on tips. The second is the SALT deduction, no tax on overtime, and the last is the opportunity zone. So the tip income passed in 2025 in July. Again, it's a tax deduction for tips in specific industries. No tax on tips would be eligible from 25 through 28. It's $25,000 of qualifying tips. I think the big thing in the piece that kind of folks are saying is, well, I don't have to pay taxes. Well, you kind of do, right? And the taxes that you're going to pay are Social Security and Medicare on those tips. And secondly, you're also going to have to pay state taxes on those. And the tax deduction applies to workers in specific industries or occupations. And we've released a preliminary list here of 70 eligible occupations. So in the beverage and food services, that would be wait staff, bartenders, food servers, chefs. Entertainment would be gambling, dealers, casino workers, dancers, musicians, hospitality, bellhops, concierge, housekeeping staff. Home services would be landscapers, cleaning service workers. Personal services would be salon owners or hairstylists, massage therapists, tattoo artists, and babysitters. And then lastly, on transportation and delivery would be delivery drivers, rideshare drivers, and delivery people. So with that being said, right, what are the kind of look at as what still needs to be taxed? We talked a little bit about the payroll taxes. So they would be subject to Social Security and Medicare tax. They would also be taxable. We have some folks that are dialing in from New York City. So those state and local taxes certainly would apply as well. Now, mandatory service charges. So let's say I have some service delivery that needs to take place and they put a mandatory service charge, or I have a large party at a restaurant and I have an 18% gratuity for a large party. Those are considered wages, not tips. And at that point, they're fully taxable. So really from a perspective of how is it calculated? How do you figure it out? And then that goes back to the whole piece about adding burden. High income earners are as well. If it's for single individuals, if your annual income's over $150,000, you phase out. And for those earning over $300,000 for filing jointly, those would phase out as well. So that's high level tax on the tips. Salt deduction. This is, you're saying, what does it impact the business for? Well, it's really an individual rule, but it's going to impact the business specifically for those that are in the state of Connecticut, in New Jersey, and Massachusetts. There's something called a pass-through entity tax. So looking at this, the salt deduction cap, which is the state and local tax on the individual side, increased from $10,000 to $40,000. This phases out for high earners over a certain income level, and essentially it's from 2025 through 2029. So the impact of this on an individual level would be that you're able to deduct up to $40,000 of state and local taxes. So the tax savings on that, if you have a tax rate of 30%, would be $9,000 to your benefit. So what does it mean for the business? The question is what am I more beneficial doing? Having and paying that pass-through entity tax through the business, or am I better off paying that estimated tax individually? And our belief, and from a planning perspective, is that you should continue to pay your pass-through entity tax payments specifically through your business so that you get the deduction and it will reduce your taxable income, which will impact your federal and state taxes, both from the deduction. So it's certainly something that we need to look at. So what is the net income and what is the deduction? Deduction on overtime. The deduction for qualified overtime compensation, not including tips. This is again, it's from 25 through 2028. It's the deduction is limited from 12.5 to $25,000 for those that are joint filers. Its deduction is available if for any of the individuals, whether or not they itemize or non-itemize. And this is really from you as an employer perspective. As you can see, I've got this overtime and weekly timesheet because many of you will be compensating your staff in regards to overtime, and something certainly to consider and what the impact would be. And I'm going to get into that once I get into the compliance section. The last piece of the new legislation that I thought would be pertinent, again, there's a lot more of the legislation. I'm just trying to give you the highlights. Qualified opportunity zones made permanent. So qualified opportunity zone is I sold a piece of property. I have a significant capital gain. I can now put this starting in 2027 into another investment, and it allows me to take a credit so I don't have to pay that capital gain. An opportunity zone potentially could be in the city of Waterbury, city of New Haven, city of Bridgeport, so that incentive goes through and I'm excluding my capital gain or reducing my capital gain tax. So certainly something more from a strategic perspective, but certainly something to think through. Compliance. I wanted to go over the 5 really big high level pieces that I think that are pertinent for us that own businesses. One is the employee retention credit. Second is the third party reporting. Third is the employer specific benefits. Fourth is reporting overtime and tip income, how that's going to be done. And then changes to the 1099 reporting. IRS has not changed the reporting requirement for 1099 since 1952. So this is a significant change, one that we certainly should take a look at. One of the things on the COVID-related employee retention credits, many folks had applied for those. They were frozen for a period of time. This act now puts significant compliance efforts in. There was significant fraud that took place. So what this act does now is puts a task force and puts significant penalties for those that applied for and took the employee retention tax credit. In regards to they didn't amend their tax returns, they didn't file for the appropriate paperwork. So this now is going to put them at more of a underneath a magnifying glass. Number 2 is the de minimis rules for third-party networks transactions. Those are folks that are collecting on Venmo, PayPal, Zelle. So with those, you would get a 1099K. That 1099K was under a certain threshold. Now it has increased effective January 1st, 2026, will go to $20,000. Before it was $5,000. So it's a significant change from where we were. So those that are selling on eBay, selling PayPal, or collecting revenue from Zelle or Venmo. This allows you that the reporting requirement from these organizations to the IRS will be with the increased thresholds. Employer-specific tax benefits, again, I'm going to go through this really high level. Really, it's on the Paid Family and Medical Leave Act credit. There's a significant credit there, becomes permanent, and is expanded to include insurance premiums. Certainly something that we should take a look at for each and every one of you. Those that are offering child care credit, that child care credit is increased and is now indexed for inflation. And then lastly is those that were helping employees with their student loan assistance. There's an exclusion that is now made permanent and is also adjusted for inflation starting in 2026. You will note that a lot of this is of the legislation for the One Big Beautiful Bill is extended and is also adjusted for inflation. This was never taking place in previous legislations, so it's another factor that they've sewn into the bill that allows them the ability to increase the inflation adjustment. Looking at this, there's from a reporting perspective, and I've gotten a lot of calls about this, about what's my responsibility from an employer versus my employees' responsibility um, for filing their taxes for 2025. As we've talked about, overtime is not taxable up to a certain amount, and then the tip income reported, again, is not taxable, but is subject to Social Security, Medicare, and state and local taxes. So looking at this, the employer responsibility is really, or employer responsibility is really from a reporting perspective, and you should be talking to your payroll service providers and making sure that they are putting the necessary pieces in place. If you look at the upper right-hand corner, the W-2, those boxes have been dedicated more for the reporting piece. So in there, there'll be a specific box that'll say what the taxable tip income was, and then secondly, what the overtime was. The employee will now take this and they'll take that deduction of overtime and tip income. And this is a looking forward to a future Schedule A that will be on the tax returns for the 1040s for 2025. This is again a preliminary shot is what the IRS is doing. And it's saying, hey, no tax on tips. Here's the calculation. No tax on overtime. That's calculation. So this again is just on this piece, doesn't take into consideration any of the other individual sections. This is just really from you folks as employers, what things you need to be taking a look at, right? You'll be responsible for reporting it to them on the W-2, and then on when they file their personal returns, that's when they'll make that adjustment. Again, if anybody asks your employers, there's no reason to itemize. This is an above the line deduction. So the future requirement we talked about for 1099s, it's gone from $600 to $2,000. So moving forward after 2025, so really effective 1/1/26, anybody that earns up to $2,000 or below $2,000 will not be required to file a 1099. It will be anybody below for this year or above $600 for 2025. But for next year, it'll be anybody above $2,000. So what that does is it reduces our burden. We're not going to have to produce as many 1099s for our clients, and for you folks, you won't have to issue as many because many of your folks are right at the $600 or $800 mark for 1099s. This includes non-employee compensation, other income, rental income. So this is really just something to consider as you start putting together a plan for what the future is. Talking about the future and strategic changes forthcoming from One Big Bad Bill. Again, this is really a strategic investment. And really what this is what the tax legislation looks like into the future. And the One Big Beautiful Bill actually has some credits in here for spaceports. And what I mean by a spaceport is looking at putting a city or a community out in outer space. Yeah, I know it's crazy with the robot and the rocket ship, but this is certainly something in the legislation. And I guess the question is, and I'll bring that to the next chart, Do you see investment opportunity in this? Right. And, looking at these pieces, we could have thought about something about a cell phone many years ago. We can look at Tesla stock, right? Tesla stock before COVID versus now. Granted, it took a little bit of a hit when they came up with the new legislation that there's no more energy credits. And I know that Elon wasn't very happy with Mr. Trump, but overall, I mean, you can see that this is strategic in nature. And the bottom picture is really the internet. I think about myself when the internet first came out to where it is today and how much we rely on it. Again, looking at the cell phone, I remember getting my first cell phone as a salesperson and having it in a bag in my car. And that was the only place that I was using it rather than in my pocket now or on my desk. So these are really strategic, things to look at. And as I said, when I talked about this earlier, the two bookends. One is the sunsetting rules versus the future rules, or the future changes. That's where the bigger dollars are. So those that are sunsetting, whether it be the TCJA, the tax rate changes, to this opportunity. Obviously, this is more strategic. It's 20 to 30 years out, but from an investment perspective, you certainly may want to take a look at this. What are the major negatives of the bill? This is going to be a significant increase to the national debt. We're talking almost $3 to $4 trillion, this bill. So it's pretty significant. We are also looking at significant changes to the risk of Social Security and Medicare benefits. There was an article that was in the Wall Street Journal last week that up to 80% of those on Medicare will see an impact on their Medicare benefits due to this law. Looking at food aid for Americans, looking at SNAP funding, that will be lost and no longer exist. We'll also see a significant increase or acceleration of the insolvency of Social Security system, potentially, and that's certainly something to think through. Those of us that like the green world or thought that was the way to go, we'll see that rolled back, and that doesn't look like that will be coming forward in the future. We talked a little bit about the immigration enforcement, and then obviously the last piece is the education access, whether it's student loans, repayment programs, those are all changing, being reshaped by this bill. Some tax planning strategies. We're almost done, folks. Retroactive catch-up for deduction for domestic research and development, certainly something to think through. What investments did you do? What research and development can you go back and look at? This goes back to 2021. So it gives you the ability to go back and amend your returns because it allows that immediate ability to retroactive and catch up on that deduction. Number two is take a full advantage of the employer provided benefits, which we talked about, student loans, looking at the childcare, etc. Those are still certainly available. Also, optimizing pass-through entity taxes, the SALT planning, right? Should it be taking the deduction at the state and local tax level individually, or should we be doing it at the partnership and corporation level? Refine the entity structure. Give us a call. Talk about what is my entity type? Should I be making changes? Look at income timing. When is the income coming in? When should I be taking it? What's my owner's compensation? Is it reasonable? Should I be taking more distributions rather than salary without, butting up against the rule that I have to have a reasonable salary as an S corporation officer? If you're a new startup, potentially looking at the small business qualified stock option, certainly something to think through. Or if you're planning on exiting and you need capital raises, let's have a discussion about that. If you're in the construction industry, look at the accounting method now that's changed for leveraging the new contracts accounting method. Review your energy vehicle alternative fuel credits before they phase out. And then charitable giving and corporate contribution planning, certainly take a look at that. Interest deduction, having the ability to take those interest deductions that you weren't able to do in the past that you aren't able to do moving forward. Watch reporting and compliance relief changes. As I said, these rules are changing every day. They came up with theory and now it's becoming black and white into law. And then the year-end tax moves. Obviously, there's some this year that we can make, but I think there's more in the future. But make sure that you make those year-end tax moves. What to watch out for. High level, here's some things that we need to consider. Phase out and thresholds, making sure that your income level doesn't diminish or lose the benefits of some of these, whether it be for QBI, whether it be for overtime or tips. Small changes in income deductions can push you over, so we certainly need to look at those. Timing and placed in service rules, understand what the timing is. When is it expiring? Is buying something, if it's not enough, what dates should we be using? Also, understanding the different implications of state and federal interplay. What pass-through entities tax payments should I make now versus what should I be taking out on my salary versus what I should be doing in estimated tax payments? What's my threshold? What's my biggest benefit? Making sure you keep really good records. And then lastly is going back to those sunset, expiration of certain credits, making sure you know when those credits are expiring. So looking at this, we talked today about the renewed or those that were sunsetting, the amended changes, some new legislation. We talked about some compliance things and things that were changing in regards to reporting, etc. We also talked about some outlandish things, but again, we thought the electric car was outlandish. And I think the stock price is over $400 per share for Tesla. We talked about the pros and the cons of it, and we also talked about some tax planning opportunities. Looking at a firm, as we talked about earlier, we are going more to advisory and consulting. That's our real goal. And hopefully this is just one step to put you there. Hopefully this was proactive, it was strategic, and it was thoughtful. Obviously, there's a lot of content in here. We try to make it as simple and as easy for you to digest and to process. We're giving you the highlights. Look forward to the individual tax return. I'm going to close out right now for thank you. I just wanted to see if there was any questions that I could potentially answer.